Did you know that only knowledgeable stock investors who invest for the long term usually make substantial profits? Hey there, MoneyMind Quest champs. Today we're exploring the world of stock market hacks for beginners. Whether you're just starting out or looking to enhance your investment strategy, this video is packed with insights to help you achieve financial freedom faster. If you're all about making smart financial decisions, hit that subscribe button and stay tuned till the end to uncover the secrets of successful stock trading. Get ready to stay wealthy. Let's dive in. First things first, let's clarify what stocks are and how they fit into your personal finance journey. Stocks represent ownership in a company, and buying shares means you own a piece of that company. The goal: to buy low and sell high. Warren Buffett, one of the most successful investors, advocates for long-term investing over short-term trading. He recommends buying high-quality companies with strong fundamentals and holding them for extended periods. Buffett stresses understanding the businesses you invest in and focusing on companies with a durable competitive advantage. His principle, buying a wonderful company at a fair price is better than buying a fair company at a wonderful price, highlights his value investing approach. Investing in stocks can offer a range of benefits, particularly when it comes to potential tax advantages. Holding onto stocks for more than a year could qualify investors for long-term capital gains tax rates, which are typically lower than short-term rates, providing a significant tax saving compared to frequent trading. Additionally, dividends received from qualified stocks might be taxed at a lower rate than ordinary income. For those who choose to hold stocks within tax-advantaged accounts like IRAs or 401ks, the growth can occur tax-deferred or even tax-free, depending on the account type. This means that the investor can maximize their investment returns over time without the immediate tax impact, ultimately enhancing their wealth accumulation strategy. Now, let's talk about some unconventional insights into the stock market. One key tip is avoid chasing hot tips or quick gains. Successful investors focus on long-term growth and stay disciplined in their strategy. Also, steer clear of emotional trading. Market fluctuations can be unpredictable, and knee-jerk reactions often lead to losses. Balancing stock trading with other investment strategies is crucial for a well-rounded financial plan, particularly when considering creditor protection, tax planning, and beneficiaries. Diversifying investments across various asset classes such as real estate, retirement accounts, and insurance policies can provide a safeguard against market volatility and offer creditor protection features that stocks alone might not. We'll share a bit more about this later. Harnessing AI intelligence can be a game changer. Using AI technology to analyze market trends, helping you make informed decisions. Start with small investments to test the waters and gradually increase as you gain confidence. Reliable AI tools can greatly enhance stock trading by providing advanced insights and analysis that traditional methods might lack. These AI platforms process vast amounts of data quickly, identifying trends and patterns that may not be visible to the average trader. Tools like algorithmic trading systems, robo-advisors, and sentiment analysis software offer investors the ability to make informed decisions with greater accuracy and speed. However, it is important for investors to use these tools as an aid rather than a replacement for their own research and judgment. Relying too heavily on AI without understanding its strategies can be risky. Investors should avoid blindly following AI-generated recommendations without considering market conditions, their own risk tolerance, and the broader economic landscape. By thoughtfully integrating AI tools into their investment strategies, investors can enhance their decision-making while maintaining a balanced and informed approach to stock trading. Let's talk about the risks. Stocks offer potential for high returns, but they also come with risks. Understanding the risks and tax implications of stock trading is essential for both novice and experienced investors. At a basic level, holding stocks exposes investors to market risk, where fluctuations in stock prices can lead to potential losses. Additionally, company-specific risks, such as poor earnings performance or management issues, can impact stock value. Investors may also face liquidity risk, where selling a stock quickly might not be possible without affecting its price. Beyond these common issues, there are more nuanced risks and pitfalls. Behavioral biases such as overconfidence or herd mentality, which often leads investors to follow the crowd without independent analysis, can lead to poor investment decisions. Furthermore, technical risks like reliance on high-frequency trading algorithms can exacerbate losses during market instability. On the tax front, profits from stock trading are subject to capital gains tax, and failing to account for the impact of capital gains on overall tax brackets can lead to unexpectedly high tax bills. As earlier stated, short-term capital gains derived from stocks held for less than a year are generally taxed at higher ordinary income rates, while long-term capital gains benefit from lower tax rates. Advanced considerations include the strategic timing of trades to manage tax liabilities, such as selling underperforming stocks to offset gains. This is known as tax loss harvesting. Moreover, holding stocks in tax-advantaged accounts like IRAs or 401ks can defer taxes on earnings, allowing investments to grow without immediate tax consequences. However, investors should be aware of the specific rules governing these accounts, including contribution limits and required minimum distributions. Diversification is your shield against market volatility. Spread your investments across various sectors and asset classes to minimize risk. Remember, no single stock should dominate your portfolio. Balance is key to long-term stability. By investing in a variety of stocks rather than putting all funds into one company or sector, investors can mitigate the impact of market volatility and specific company risks. This strategy allows for balancing potential gains and losses, as different stocks may perform differently under varying market conditions. To effectively diversify, investors should consider factors such as industry trends, company size, geographic location, and economic cycles. Exchange-traded funds, ETFs, mutual funds, and index funds can also provide diversification by offering exposure to multiple stocks within a single investment vehicle. So ensure you have a diverse mix of stock options and regularly review and rebalance the portfolio to maintain diversification levels, which is crucial to aligning investment goals with risk tolerance over time. Now, let's uncover the secrets of successful trading. A major successful trading key is staying informed with reliable sources. Patience and consistency are your allies in the stock market. Recently, Forbes.com listed some platforms renowned for credible stock market insights and analysis in North America. They include Morningstar, known for its comprehensive research reports. Morningstar provides detailed analysis and ratings of stocks, mutual funds, and ETFs, helping investors make informed decisions. Seeking out for this platform offers a unique blend of crowd-sourced investment research and analysis from financial experts. It provides articles, stock market news, and investment ideas tailored to individual investors. Barron's, a trusted source for financial news and analysis. Barron's delivers in-depth market commentary, investment insights, and stock recommendations that cater to both novice and seasoned investors alike. Keep emotions in check and stick to your strategy. Use stop-loss orders to protect your investments from significant losses and stick to your predetermined strategy to avoid emotional decisions. A stop-loss order is an instruction you give to your broker to sell a stock automatically if its price falls to a specified level. This level is known as the stop price or trigger price. Once the stock hits or goes below this price, the order becomes a market order and the stock is sold at the best available price. Setting the stop price determines the price at which you're willing to sell the stock if it starts to decline. This price should be chosen based on your risk tolerance and the stock's volatility. Placing the order. Enter the stop price when placing your order with your broker. This can usually be done through your trading platform or by calling your broker directly. Monitoring and adjusting. Regularly monitor your investments to assess whether adjustments to your stop-loss orders are necessary. As the stock price increases, you may choose to raise the stop price to lock in profits and protect against potential losses. Stop-loss orders help protect your investments in several ways. Mitigating emotional decisions. They prevent you from making impulsive decisions based on fear or greed during market fluctuations. Limiting losses. By setting a predetermined exit point, you can limit potential losses if the stock price moves against you. Preserving capital. Protecting your capital is essential for long-term investment success. Stop-loss orders help minimize the impact of significant market downturns on your portfolio. Volatility and market conditions. Highly volatile stocks may trigger stop-loss orders more frequently. Adjust your stop prices accordingly based on the stock's price movements and overall market conditions. Long-term versus short-term investing. Stop-loss orders are particularly useful for short-term traders looking to manage risk. Long-term investors may also use them to protect gains or limit losses during volatile periods. Before diving into stocks, establish a strong financial foundation. Start with an emergency fund to cover unexpected expenses and pay off high-interest debts. Assess your risk tolerance and set clear investment goals. This clarity will guide your decisions in the stock market. There you have it, champs. Investing in stocks can pave the way to financial freedom, but it requires knowledge, discipline, and a strategic approach. Building wealth through stocks is a journey, not a sprint. So start smart and gradually. Remember, the journey begins with building a strong financial foundation and continuous learning. Be sure to check out this video on financial education. Don't forget to smash that subscribe button and join the MoneyMind Quest champs for more insights on mastering personal finance. Until next time.